Hey everyone, welcome back to Corporate Dakota, the place where we try to peek behind the curtains of corporate America. Today we are diving into a rather thick report from Fidelity MT Vernon Street Trust covering their latest annual shareholder report. It may sound dry, but trust me, there are some juicy details about how your investments are doing and where the money is going. Let's decode this together. This report is for Fidelity Growth Strategies Fund, and it lays out their performance from the 1st of December of last year all the way to the 30th of November of this year. Think of it as a yearly checkup for the fund. First off, let's talk about costs. Nothing is free in investing, right? For a hypothetical $10,000 investment in Class A shares, the cost for the last year was about $101. That is a little less than 1%. For Class M shares, it was $127 or 1.24%. Class C shares cost $177 or a bit over 1.7%. And importantly, Class I shares, which are usually for larger investors, cost just $77 or 0.75%. These are the fees that eat into your return, so it is good to know what you are paying. Now for the important part, what made the fund perform the way it did. The report says US equities had a strong finish for the year ending November 2025. Thanks to a solid economy and the Fed lowering interest rates, the fund did well against its benchmark index, the Russell Mid-Cap Growth Index, largely because of smart stock picks in industries like industrials, but also healthcare and information technology. They highlight Robinhood Markets, which saw a huge 235% gain, and they had an overweight in it. That is a pretty big bet that paid off this period, but it is worth noting they decreased their investment in it. Another contributor was Howmet Aerospace, up 74%, which was their biggest holding at the end of the period. Then there was Sterling Infrastructure, up 84%, a new position opened this period, and it became one of their largest holdings. But it wasn't all good news. A big drag on performance versus the benchmark was what they call an underweight in healthcare. Basically, they didn't own enough of the healthcare stocks that did well. They also mentioned avoiding IDEXX Laboratories, a company that gained 79%, which hurt their results, and holding Coinbase Global, which lost 21%. They did make some big shifts, cutting back on energy stocks and taking on more healthcare. That is a strategic move reflecting their view on where the market is headed. Looking at the long term for Class A shares with the sales charge, an initial $10,000 investment is now worth $9,425, which is a loss. Without the sales charge, it is up to $10,781. The benchmark index, Russell Mid-Cap Growth Index, did better without the sales charge at $11,434. For the 1 year return, Class A shares with the sales charge were down 0.98%. Without it, they were up 5.06%. The Russell Mid-Cap Growth Index was up 3.29%. Over the life of the fund, Class A shares, including the sales charge, had a solid 11.50% annual return, but without it's a massive 17.41%. The benchmark index over its life is 15.63%. Let's look at some key fund statistics as of the 30th of November 2025. The fund size is a hefty $4.1 billion. That is a lot of money being managed. They hold 171 different investments. The total advisory fee is close to $26 million. Portfolio turnover, which is how often they buy and sell holdings, is 58%. What did the fund invest in? Industrials are their biggest bet at 33.2%. Information technology is next at 18%. Consumer discretionary is 15%. Healthcare at 10.5%. And financials at 9.1%. Notice that energy is only 1.7%, a pretty low allocation, and they did decrease exposure to it. This sector breakdown gives us a clue about their strategy. Heavy into industrials and tech makes sense given the market performance they described earlier. They are betting on companies that drive the economy and innovate. Looking at the top holdings, Howmet Aerospace is number 1 at 4.6% of net assets, followed by Axon Enterprise at 2.8%, and Fair Isaac Corp at 2.4%. Sterling Infrastructure is also in there at 2.3%. These numbers are for Class C shares. The costs are higher here as expected, with Class C shares costing $177 on a $10,000 investment. That is 1.73%. The cumulative performance shows it is worth $10,000 after the sales charge and $11,427 without. The average annual returns are also a bit different, with Class C having a 3.37% 1 year return, including the sales charge. The life of fund is 16.6%. Then we have Class I shares, which are typically for institutional investors and have the lowest costs. $77 for a $10,000 investment, or 0.75%. Its average annual total returns are even better at 5.28% for 1 year and 17.67% for life of fund. This shows how much fees can impact your returns over time. Now shifting gears to the Fidelity Series Growth Company Fund. This fund's investment objective is growth, and it is geared towards certain retirement plans. For this fund, the advisory fee is zero. That's right, 0, this means more of your investment goes directly towards growth. The fund invested heavily in common stocks at 95.6%. Their top sector is information technology at 33.2%, followed by communication services at 13.3%. Nvidia Corporation is their top holding at a massive 16%. Apple Inc. is second at 8.1%, and Microsoft Corp is third at 7.7%. This heavy concentration in tech giants shows a clear bet on those large cap innovative companies. Looking at the financials for Fidelity Series Growth Company Fund for the year ending the 30th of November, 2025, total income was over $80 million. Expenses after reductions were quite low at just over $300,000. Net investment income was positive then at nearly $80.5 million. But the real story is in the gains. Net realized gain from investment securities was over $2.1 billion. And the change in net unrealized appreciation was another $2.2 billion. That is a massive gain of over $4.3 billion for the year. Let's break down that performance on a per share basis. For 2025, the net asset value per share was $29.76. This is up significantly from $26.64 in 2024. The total return for the year was a strong 25.27%. Auditors, Deloitte and Touch LLP have given a clean opinion on the financial statements stating they present fairly in all material respects. This is generally what you want to see. Now let's look at the Fidelity New Millennium Fund. This fund aims for growth as well, but with a slightly different focus. For the year ending the 30th of November, 2025 reports a strong gain. Nvidia is also a top holding here, but at a lower percentage at 8.2%. Apple Inc. is at 6.3%, and Microsoft Corp at 5.4%. Notably, Amazon.com is in their top holdings at 4.7%. Costs for this fund are $81 for a hypothetical $10,000 investment, so 0.76%. That is quite reasonable for an actively managed fund. The financials show investment income of over $43 million, but expenses nearly double that at $38 million plus a large performance adjustment of $7 million. This resulted in a net investment loss of nearly $9.8 million. However, the realized gains were substantial at over $278 million. The change in unrealized appreciation also added over $376 million. This highlights a common theme in growth funds. The bulk of the returns come from capital appreciation, not income. The year-end net asset value per share was $75.76, up from $77.37 in the prior year. Remember, this is after distributions. The total return for shares sold was 5.38%. The life of fund return going back to the 8th of October 2024 was actually 17.67%. This is a really strong life of fund return. Next, we have Fidelity Growth Strategies Fund, also known by its ticker FDEGS. This fund's costs were $71 on a $10,000 investment, which is 0.69%. Their investment objective is geared towards growth, so it's no surprise that information technology is their top sector at 50.2%, with Nvidia Corp as their top holding at 16%, Apple Inc. at 8.1%, and Microsoft Corp at 7.7%. This fund is heavily concentrated in the tech giants. The performance commentary here is very similar to the other growth strategies funds. A strong US equity, market driven by corporate fundamentals, resilient economy, and Fed rate cuts. Security selection was key, particularly in information technology. Major contributors included SanDisk and Ciena, with Nvidia being their largest holding. Finally, let's look at the Fidelity Growth Company Fund. FDGRX costs here are $77 per $10,000 investment, or 0.69%. Information technology is again the leading sector at 51.2%. Nvidia Corp is again their top holding at 16.3%, followed by Apple Inc. at 8.3%, and Microsoft Corp at 7.8%. The strategy here seems consistent with the other growth strategies funds placing big bets on the leaders in technology. The financial statements for these funds show substantial net assets. For example, Fidelity Series Growth Company Fund has over $20 billion in net assets. Fiscal year, end reports give us a snapshot of this massive scale. The market sector breakdown for Growth Strategies Fund shows industrials at 33.2%, information technology at 18%, and consumer discretionary at 15%. This is quite similar across the board, hinting at a consistent investment philosophy. The reports also mention changes to the fund during the reporting year, specifically noting that the fees associated with certain classes changed. This is important because even small fee differences can add up over time. Overall, what we're seeing is a consistent theme from Fidelity's growth strategies funds. They are heavily invested in information technology and industrials. With major holdings in the large cap tech leaders like Nvidia, Apple, and Microsoft, the performance has been strong in the recent period, driven by security selection and a favorable market environment. However, the significant concentration in a few tech stocks does present a risk if those sectors face a downturn. Their strategy appears to be a bet on continued innovation and resilience in the US economy. The reports also highlight the importance of understanding the fee structure for different share classes, as those costs can make a noticeable difference in long-term returns. We will be keeping an eye on how these funds navigate potential market shifts and sector rotations. What are your thoughts on these Fidelity funds? Are you invested in any of them? Let me know in the comments below. If you found this deep dive helpful, please give it a thumbs up and subscribe for more corporate decoder reports. Don't forget to join our Discord community linked in the description to continue the conversation. Thanks for watching. See you next time.